It's time for our Dollars and Cents segment, which is every week we bring to you a good financial tip to help you give you the greatest likelihood of achieving your goals in retirement with your money, which for most of you means having the lifestyle that you want to have and feeling like, being secure that you're not going to run out of money. We know there's no guarantees in life, but you certainly don't want to have life left at the end of your money. So today for our Dollars and Cents segment, I want to talk about the importance of great diversification in your portfolio. This is so important. The traditional look in terms of how most have done it over the years is that for diversification, unfortunately, when we hear that word, we think that if we have some stock mutual funds that have, say, 150, 200 stocks in them, and we've got a few of those, then we're diversified. Or maybe we add some U.S. bonds in the mix, and the way most people do that is with a bond fund, and it's U.S. bonds. We think, well, okay, we've got the stocks and we've got the bonds. But first off, within the stocks, you think, well, I've got all those stocks, I'm surely diversified. Well, but you're only diversified within one category of assets, and that's stocks, maybe U.S. stocks and foreign stocks, but it's still stocks. And no matter how well diversified you are, if we have a real meltdown in the market or even a significant correction where we saw a 15, 20, 30% correction, and even if you have a great mutual fund, what do you think your fund's going to do if you're all in stocks? It's probably going to go down a good bit, and probably more than you're comfortable with. And so that's really not enough diversification. It hasn't worked very well the last 10 years. And then you add, maybe you've added some U.S. bond funds to the mix, and so you think you're diversified. Well, that's been kind of traditional. And I will say over the last 10 years, the inclusion of those bond funds have certainly helped, because as you may be aware of, it's very important to realize that the value of bond funds very much moves in an opposite relationship with interest rates. So if interest rates are going down, then bond values go up. But if interest rates are going up, then bond values go down. And we have ended, in my opinion, a historic bull market in bonds. I mean, in 1981, you could buy a CD at 16, 17, 18%. Now it's still hard to get 1% on a 1-year CD, unless it's a bank offering some sort of a teaser rate. So we've had a precipitous drop in interest rates. There's been ups and downs along those times, but over 28 years, we've seen a precipitous drop in interest rates. That would be a historic rise in the bond market. And so over the last 8 or 10 years, having those bonds in the portfolio have really helped you. But remember, first off, just having the mix of stocks and bonds, for most people, if it's a 60-40 type mix, you still would have maybe only kept up with inflation over the last 8 or 10 years in a typical portfolio. There's certainly exceptions to that, but the stock market itself over the decade of 2000 through the end of 2009, you would have actually lost a little bit just being in the stock market as measured by the S&P 500 or the Dow Jones. Well, but we don't own things for what they've done in the past. We own them for what they're likely to do in the future. Interest rates are likely, in my opinion, to go up in the future. And that's what inflation creates. It creates a period of rising interest rates. We're already seeing some of that with medium and longer term bonds. And even treasuries, we're seeing those increases. Eventually, most people feel like we're going to see precipitous, maybe even rises in interest rates. That's going to make bond values struggle. So what if we see more boom and bust in the stock market as well? That's what we've seen the last 10 years. We've seen 10 years of boom and bust, where over the 10 years we've had a lot of booms, we've had some busts, but the market as a whole is pretty much sideways. What if we see more of that and we see interest rates rising? Where are you going to get the return from? It's going to be hard. And, what I'm all about, and what you'll hear me say over and over again, I'm not about necessarily trying to figure out how you can make the most amount of money. Because we don't know. Nobody knows. We don't know what the stock market holds the next 8 years. Does that mean you should go out, and if we feel like we're going to see inflation, you should go out and put all your money in gold and silver? No, it doesn't mean that either. You don't want to bet on any one thing like that, because what if you're wrong? At this point in your life, you're probably not looking to make 12 or 15% a year, over time. I mean, granted, we'd all like to make that, but what's your goal at this point in your life? Is it to try to make as much as you can? And we all want to make that money, or is it to just have some steady growth so that you feel like you have a high probability of achieving your goals under a lot of different economic circumstances? See, over the next 6 or 7 or 8 years, there's a lot of things that could happen economically. And, if you're in a traditional portfolio that I typically see, where you've got mostly stocks, U.S. and foreign stocks, and maybe a mix of some U.S. bonds, I'm just afraid that if we see more of what we've seen the last 10 years in the stock market and we see high interest rates, I'm concerned that you're not going to really be successful with that type of an approach. Now, if we have a healthy market and we're able to keep inflation under control, you will be successful more than likely. But what if those things don't happen? So it's all about having what diversification really means is that you have a lot of things in your portfolio that don't move together. And to me, having the mix of stocks and then maybe some U.S. bonds is not enough. I think you need more other stuff. Foreign bonds is kind of a non-standard asset class. A Swiss franc asset, the Swiss bond, is a good thing to do there. Precious metals, of course, is a non-traditional investment holding. Inflation-protected securities. There's just a whole lot of things you could do. I could just go on and on and on. And there are actually ways that we can measure your diversification. In other words, we can look at how highly correlated the different assets are that you have in a portfolio. In other words, at looking how much do these things move together. See, if you got a lot of things in your portfolio that don't move together, then if one of them's way, way down like stocks, that doesn't mean they're all down. And that's what you want. You want a lot of asset classes in your portfolio that have good potential for growth, but where they don't all move together, because if they all move together and things don't go well, you're not going to be happy. But if they don't move together, you're not depending on any one thing happening to feel like you can have success over time. And there are actually tools, again, that we can use to measure the amount of diversification you have. And then we can even show you, there are a lot of ways to show you how that would impact your success, at least how it would have in the past in difficult market environments and in good market environments, where you can feel like you can have some good, reasonable growth regardless. Of course, understand there's no guarantees. As you know, past performance is not a guarantee of future results, but there's just a lot of things you can do to improve the probability that you're going to be successful.